There is no denying that the U.S. financial system is at its weakest point in years. The stock market is in a constant state of flux, interest rates are rising, and consumer confidence is at an all-time low. The U.S. financial system is under intense stress. The combination of a strong dollar, low oil prices, and weak emerging market growth has wreaked havoc on the capital markets and bank balance sheets. This perfect storm has killed off many small banks, restricted lending at larger banks, and forced investors to sell assets or raise equity at distressed prices. Wall Street reeled this week on fears of rising interest rates, a stronger dollar, and fears of a trade war. During the financial crisis, the financial ETF declined by 80% from its peak from mid-2007 to early 2009. The fund is still currently down, although now at 20% from its peak, it is still trading for nearly the same price as its 2007 peak. This is as a result of the strong dollar increment rate. The financial stock is tumbling at a high rate, and the U.S. financial system is highly vulnerable to a major shock. The stock market is overvalued, and a sharp correction could trigger a financial crisis. Welcome to Savvy Economists. In this video, we will be talking about the weak state of the United States financial system. Don't forget to please watch, like, and share this video if you enjoy it. Also, leave your comments and thoughts below, and don't forget to subscribe to the channel for more related content similar to this. The market capitalization of the stocks in the S&P 500 was at $40.15 trillion as of January 2022. That's about 2 times more than the size of the entire U.S. economy, which is currently worth about $20 trillion. But this doesn't feel like a bubble to most people because it's in stocks and not housing, art, or anything else that can be easily compared with the value of a house, painting, or guitar. The truth is that Wall Street has been enjoying an unprecedented run of prosperity for the past few decades, thanks to deregulation and other policies that have allowed banks to make enormous profits from trading securities without worrying much about whether those securities are actually worth anything or if they'll ever be paid off. But as we've said before, this kind of prosperity isn't sustainable forever because there's only so much money you can make by flipping paper repeatedly. And now we're starting to see signs that it's time for investors to start worrying about what happens when things stop working out so well. The question here is why the U.S. financial system is laboring. There are a number of reasons why the U.S. financial system is laboring. One of the key reasons is the country's high levels of debt. The U.S. government is currently saddled with over $20 trillion in debt, and that figure is only expected to grow in the coming years. This debt burden puts a strain on the economy and makes it difficult for the government to invest in vital infrastructure and services. Another reason why the U.S. financial system is struggling is the country's trade deficit. The U.S. imports far more than it exports, and this trade imbalance puts downward pressure on the U.S. dollar. This makes it difficult for U.S. companies to compete in global markets and puts a strain on the economy. Finally, the U.S. tax system is also a significant drag on the economy. The country has one of the world's highest corporate tax rates, making it difficult for U.S. companies to compete globally. The tax system also discourages investment and innovation, which are key drivers of economic growth. There are many factors that have led to the current state of the U.S. financial system. One of the main forces is deregulation. This has led to more risk-taking by financial institutions and has contributed to large-scale problems when things go wrong. Another factor is the increasing globalization of the economy, which has led to more interdependence between economies and financial systems. This can amplify problems when something goes wrong in one area of the world and can lead to a domino effect of financial crisis. There are a number of factors at play here. First, there's the fact that the U.S. economy has been propped up by low interest rates for years now. This has made it easy for companies to borrow money and has helped to create an environment of consistent growth. But this can't go on forever, and eventually, rates will start to rise. This will put pressure on companies that have been relying on cheap debt to finance their operations, and it could lead to some big problems down the road. Second, there's increasing inequality in the U.S. The top 1% of earners have seen their incomes rise significantly while the middle class has stagnated. This has created a situation where there are fewer people with a disposable income to buy homes and cars, and that's starting to hurt businesses that depend on consumer spending. And finally, there's the fact that many of the biggest companies in America are sitting on vast piles of cash. One is that it makes the economy susceptible to shocks. Another is that it limits the ability of the U.S. to respond to economic problems. Finally, it raises the cost of borrowing for everyone in the economy. The Wall Street is contradicting reality in a number of ways. Firstly, the stock market is currently at an all-time high, yet the economy is only slowly recovering from the recession. This disconnect is due to the fact that the stock market is driven by investor confidence, which has been buoyed by the Federal Reserve's quantitative easing program. Secondly, corporate profits are also at an all-time high, yet wages for American workers have remained stagnant. This is largely due to the fact that businesses have been able to increase their profits by cutting costs, including labor costs. Finally, the housing market has begun to recover, yet household debt levels are still high. This is due to the fact that many Americans are still struggling to pay down their mortgage and student loan debt. The U.S. financial system is actually quite weak, and many experts believe that another financial crisis is inevitable. The main problem is that Wall Street is in denial about the true state of the economy. They are content to keep pumping money into the system without taking any steps to fix the underlying problems. This is a recipe for disaster, and it is only a matter of time before the whole system comes crashing down again. The good news is that there are some things that can be done to prevent another financial crisis from happening. These include: 1. Regulating the financial sector more strictly. There need to be more rules and regulations in place to prevent reckless behavior from occurring. 2. Encouraging more responsible lending practices. Lenders need to be more careful about who they lend money to, and they need to make sure that borrowers can actually afford to repay their loans. 3. Improving financial education. This is something that needs to be taught in schools so that people understand how the economy works and how to make sound financial decisions. 4. Encouraging saving and investment. People need to be encouraged to save money for their future and invest in things like stocks and bonds. The recent drastic sell-off of the U.S. stocks and the bond is an indicator that the markets are worried about the U.S. economy, especially the trade war with China, which dented the confidence of the investors. The regulatory system is flawed, there is too much debt, and the economy is far too reliant on consumption. These are just some of the reasons why the next financial crisis could be worse than the last one. Don't forget to hit the like button, subscribe, and leave a comment. Thank you for watching. See you next time.